Hey everyone, I'm Jeremy Szafron. You're watching Kitco News. Don't forget to subscribe to our channel for the latest. Well, on today's show, we're zeroing in on silver. The metal has had a tremendous run, up around 13% year to date and more than 20% in the last 3 months. At one point, almost hitting the $30 mark, currently sitting down around 3% since Friday. Now, silver is a metal with its fingerprints all over today's economy, from solar panels to electric vehicles. As industries ramp up demand and central banks tweak monetary policies, we're examining how these forces are shaping silver market's trajectory. Joining us to break down these trends is Bart Melek, Managing Director and Global Head of Commodity Strategy at TD Securities. Bart, welcome back to the show. Thanks for being with us today.
Oh, thank you for inviting me. Great to be back.
Yeah, of course. Let's talk metal. Let's talk precious metals. First, we'll start, of course, with silver. We've seen some dramatic swings in silver prices recently with a notable drop last Friday. I'm wondering, before we dive into this, explain the main factors that are driving these volatile changes and these swings with silver.
I think most recently it's probably the idea that the Federal Reserve may not be as quick to the draw on lowering rates as we thought, even a short while ago. There's a growing narrative out there that the next Fed move could even be a hike. Certainly we don't believe that at this point, despite of the fact that U.S. data is quite strong, particularly on the employment side. Inflation is quite elevated. But we don't think the Fed is going to want to get any more restrictive. Do they want to keep rates, at current levels? Probably. So what does that mean? Ultimately, it means that the cost of carry will be a lot higher. We've already had, a quite considerable amount of position changes that got us there. We got CTAs, Commodity Trading Associate, algorithmic funds following trends and capitalizing on this. But for now, I think we should maybe expect a little bit of drift lower. Some of those gains to be given back as we are pondering on what the Fed is going to do. And of course, what the Fed does will very much drive of what demand for silver at the core is. We're also getting some angst surrounding China policy right now, and that could weaken Chinese exports, certainly to the United States, North America broadly. So, I'm not at all surprised that silver moved up close to 30, to around $30 and then moved lower. But beyond the cyclical impact, looking, the longer term, I think silver is in a great position to be significantly higher where it is because it has a structural deficit problem.
Now, I want to talk a little bit about these deficits. Before we do, I guess supply and demand really is the factor here, but these are some interesting movements. I mean, is there something unusual happening to these markets? Of course, we're waiting for PCE on Friday. We got some more economic data, but silver and gold have been, somewhat very interesting this year.
Well, they decoupled, right? Gold has done extremely well at a time when the Federal Reserve has been on, a 4-decade most aggressive tightening cycle in 4 decades or so. And gold has done very well. Part of the reason that it has is because physical demand from investors, particularly in Asia and to some extent Europe, and central banks bought a record amount in 2022. They bought close to a record last year. And we continue to see China, for the 17th month in a row in March, acquiring gold into its reserves. We're seeing a full-fledged diversification away from the dollar and fiat currencies broadly among the central banks. So gold has done very well, despite of the fact that we had policy that was quite tight, despite of the fact that ETF investors were really not particularly interested. And we've seen, for the first time recently, home offices, and I think there are probably central banks a while back buying as well, and other physical investors that made gold a better bet than silver. I think that will, in the long run, change as silver becomes less of a metal dependent on the interest rate and lease rate environment in the financial markets. And there are very good reasons for that.
Okay, let's talk about some of these reasons. Before we do, I mean, obviously we'll go back to, we'll talk about gold in a minute. I want to go back to silver because we all know what an important role that metal is for renewable energy, electronics, solar panels. We talked about a little bit of them. I'm curious, these technological advancements, are they going to impact silver's demand here, but also with the supply? Let's talk a little bit about this mix.
Absolutely. Look, I think going forward, and we're not talking next 6 months because there's going to be a lot of cyclicality and a lot of movements. But when you go for a long term, 2-3 years, we've had several years of pretty significant deficits, and deficits defined as what is recycled and mined versus what is consumed in real markets. So what we've been doing is we've been drawing on inventories, and there is maybe 300 million ounces left that's unallocated that can move back and forth, in swap markets among bullion banks and et cetera. But if you have, let's say, 100 million ounce plus deficits over the next 2 years, well, that inventory, that buffer is going to disappear. And, economists or strategists like me, formally trained in how price mechanisms work, will say, well, then you're going to be in an auction price environment where the silver price is no longer on the margin set by what the marginal cost of production and developing facilities are or recycling it. It's going to be set based on your so-called marginal revenue product, or the revenue derived from that incremental ounce of silver to produce, let's say, $100,000 vehicle. Increasingly, as time moves on, we're going to have upwards of 2 ounces of silver in these EV battery-driven vehicles. They have a lot more electronics, a lot more smart devices in them, and all of them, to some degree, use silver. And the loading is going to be much greater. Well, and then you're going to get into an environment where the people who can make the most money out of using an incremental ounce or 2 ounces of silver are going to bid it up. You're not going to stop producing $100,000, $200,000 vehicle or even a $50,000 vehicle for a matter of $80, let's say, worth of silver. You'll bid it up. And you will need to incentivize inventory holders, maybe bullion holders and others who might have invested in that metal, to give it up, or somebody with a less productive use to give it up. Well, we don't really know where that price will be. It will depend on the severity of the shortage and what your opportunity cost in giving up that unit of silver is in terms of what you lose in profitability. And, and that's quite undetermined and for the most part, quite interesting. So you can have spikes much above the marginal cost of production on the mining side. And that's quite key. On the supply side, well, you know what? Vast majority of silver is from zinc, lead production, copper production, and gold production.
Right.
And we're not seeing an awful lot of investment on that side. So almost by definition, if you're building less zinc mines, or the increase is low, you're not going to get a lot of new silver either. Yeah. Primary silver, maybe there's a different case to be made for it, but we're not seeing huge amounts of investments. When we project forward the amount of silver you will need to get, let's say, to Paris Accord targets, to the CAFE standards in the United States, in the next 8 years, it's going to be well over 50, miles to the gallon. You're going to have to produce a significant portion of your fleet, 60%, if not more, in pure EVs to achieve those goals. Well, that's going to mean silver. We're going to be banking under the IRA, the Inflation Reduction Act. We've got, $340 billion allocated for the greening of the U.S. economy. Of course, Canada, other European countries are doing the same thing.
Right.
Well, that means solar panels to some extent. It means new grids. Well, you know what? Silver is used for all that. The new technology for silver uses a lot more loadings than the old technology. So if we're ramping up the generation of power and we want to make it green, yeah, silver is going to play a role. The exact timing is going to be, it's always difficult, with government policy in particular. There's cyclicality, interest rates, but I'm pretty sure 5 years down the road, silver will probably be higher than it is now. And, you often hear people talk about there's going to be a persistent deficit of silver.
Yeah.
Well, you know what? It can't happen. It's a physical commodity. At least in my reality, you can't use silver that doesn't exist to put in electronic components or solar panels.
Talk to me about this, Bart. We had a guest on fairly recently, and they were talking about the idea that the supply and demand curve is so diminished that if you were to go and physically get, for some exchanges anyway, to go and physically get your silver out, there's a possibility that they can't even give it to you and they'll have to pay cash. Are we here with the supply and the demand? I'm
not so sure, and that's an area that I don't really want to make a comment on because I haven't done a comprehensive study on that. But look, you can settle in physical, you can settle in cash. And there's a lot more going on in this market than exchanges. There is a, entire massive OTC market that I think, people don't talk much about or as much as they could be. There's a whole London bullion market and so on. And there are large holdings. There are holdings above ground in the form of silverware and others. And that is all potential supply. The question is, how elastic is that supply? In essence, what's the price point?
Right.
At what level do I take, my deceased grandma's silver and melt it?
Yeah.
And it could take a while. And, and there is the thrifting. So at some point, I will use less silver and look at technological solutions to thrift it out of my production system. It doesn't, happen overnight, but it does happen over a period. And we know technology moves on and there are responses to higher prices. We've recently seen that with platinum and palladium, where we've had these catalysts being redesigned to have a larger representation or loading of platinum versus palladium because of the price differentials that were present. So we can redesign, we can thrift, we can incentivize people to give above ground inventory. And, over the long run, we can invest in primary capacity as well. So these markets are dynamic. And, in our view, the long-term price is consistent with the marginal cost of production. But that's the long run. In the medium run, if demand spikes and the supply chain isn't available, well, you're going to have to convince somebody to stop using it, and they're going to offer it up to you or make it so expensive. So as I said, you're functioning in this, this
seems very fine line, almost a teeter-totter,
Yeah, absolutely. And there's the interest rate environment where if I get a yield, I can lend you my silver against, future production. So there are a lot of things going on. It's just not really about primary supply and demand. We've seen, as you know, I have to look far back where we had a record level of deficits and silver price went down, right?
Yeah.
That seems inconsistent with supply demand theory, but it really is because it's supply by other than primary needs. And inventories play a lot. My point is that over time, those inventories will get drawn and the supply demand fundamentals will be more indicative of how prices move.
Okay, let's talk about the investment appetite here then, because obviously while silver often follows gold, we talked a little bit about that divergent but its industrial uses give it such a unique position in the market. Are investors seeing this when they're viewing silver in comparison to gold? And what would a significant divergence between the two metals mean for investors?
Oh, I think investors definitely see it, and and ultimately, I would fully expect over time, as there's more certainty about where the economy is going over the next year or two, where government funds. Remember, in the United States, we have an election coming up where some of these environmental initiatives may be at risk. I have no idea who's going to win. I guess we'll see when we see. In fact, I just wrote a paper and published a few hours ago on that very thing. So there's still a lot of uncertainty. But once that uncertainty goes regarding the economy, future policy, and the largest market, economy in the world, I think, and we start being more sure when the Fed actually starts cutting, I think investors are going to materialize, and they're going to materialize in size.
Interesting. Okay. We're watching closely for Friday's numbers on the PCE. We got lots of data coming out from the Fed, as you just explained, especially for potential changes this year. The market currently pricing in 2. We'll see what happens. I'm curious, give us a little bit of the lay of the land. If we hear some of these data, if we go from 3 to 2 cuts, what's this going to do for silver? What's it going to do for gold in the coming months? Or what's the opposite going to do if they start easing?
Well, look, in broad strokes, higher inflation, higher than, materially higher than expected, ultimately means that the Fed remains, on the restrictive side. Weaker economy or weaker inflation means they're more likely to cut. So far, the economy has surprised in the United States, at least significantly to the upside. After the most restrictive stance in monetary policy in some 40 years or so, today we're, not today, but last employment print was 300,000 plus jobs. Wages growing at 4.5. When we look at the CPI, we're still far, far away from the 2% target. So the Fed is unlikely to do anything for now. A move from 2 unexpected, 2 cuts to 3, I don't think it makes much of a difference. 25 basis points, won't really move the needle much. But, we moved from, not that long ago talking about 6, from 6 to 2. That could be material, particularly if some of the physical buying moderates. I still expect silver to outperform gold because it has a lot of catching up to do, and the fundamentals look pretty decent going into 2025. But if the Fed were to move to, let's say, no cuts this year, or start talking about hikes if inflation doesn't budge and the economy stay, that could be negative. And it really doesn't matter what the primary supply demand numbers look. I think you would get the flow movements from investors, and that's because of carry, right? You got to think of it this way: if I'm holding an ounce of silver or any other zero yielding asset, very much like a zero coupon bond. Well, what happens when that interest rate goes up? Well, the valuation goes down, right? So we think of zero yielding commodities. And for most investors, there are zero yielding. If you're holding physical, they behave very much like a zero coupon bond with a lot more convexity because, they kind of last forever, right?
Okay, let's talk a little bit about, those are changes in the Fed's policies. We've obviously seen Iran and Israel kind of calm some tensions. We're really not sure as to what's happening, as to the latest. We're going to be keeping an eye on it. But I'm curious, the geopolitical side of things. We saw that sell-off last week for gold, for silver. It seemed to be because of that. If we see escalation or even de-escalation here, should we be watching for?
Yeah, typically speaking, a significant increase in geopolitical risk tends to be good for gold and usually is okay for silver, though silver being 60% industrial, it's not so clear cut. You can have an expectation that the demand side on the industrial areas will offset some of the investor side. So it's not as clear cut. But look, ultimately, geopolitical risk is good. The problem with geopolitical risk is if it doesn't result in, let's say, eliminating flows of oil in some areas or has lasting effects, people tend to learn to live with risk and tolerate it. And if there is no monetary policy or fiscal policy response that's long dated, there is a bit of a reversion to the mean. We kind of look at it and go, okay, that was very nice, but nothing really happened. And, there might be some risk premium, but a lot of the initial risk premium will be sold off.
Mm-hmm. No, well said. And we'll be keeping an eye on, obviously, PCE on Friday. But I could have talked to you all day, my friend. We didn't even really get to the other commodities, but we're out of time. Of course, Bart Melek, Managing Director and Global Head of Commodity Strategy at TD Securities, joining us today. Bart, always a pleasure to have you on. I appreciate your time today.
Well, thank you so much and have a great day.
We'll talk to you soon. I'm Jeremy Szafron for Kitco News. Thank you for watching today. Please don't forget to subscribe, like that video, even send us a comment. I'll be sure to watch out for them. We look forward to seeing you next time.